All right, you saw the headlines last night. Standard & Poor's downgrading Spain to BBB plus from A with a negative outlook. But if you're looking for a contrarian indicator, a ratings agency suddenly downgrading could be a buy signal, one that you might be looking for. Remember when S&P downgraded U.S. debt back in August 2011? It preceded a huge rally in treasuries that continues to this very day. And in the aftermath of last night's move, Spanish yields, guess what? They're still down, but they're below that crucial, critical level of 6%. And Spanish stocks are actually up. Here's how you want to play Spain. Greene, the head of European economics for Rubini Economics, joins us right now. And Mark Chandler, chief currency strategist at Brown Brothers Harriman, and still with us for the entire show, our guest host, Michael Crofton from Philadelphia Trust. Good to have all you here. All right, Mark, I'm starting with you. Do you think S&P is a little too late to this party?
No, in fact, I think that it's important that Spain did have a downgrade. And, you know, Spain's not late to this party. Excuse me, S&P is not late to the party. You know, they downgraded Spain by 2 notches in January, had a negative outlook for it. So people knew that another cut was likely to be coming. And now all 3 rating agencies have negative outlooks, warning that there's about a 1 in 3 chance that there's going to be another downgrade forthcoming.
But you say something very important there. You say the markets knew that this was coming. So let me ask, do you think that part of it's baked in?
Not really. I think that what's baked in is the idea that Spain is having problems. Spain has now replaced Italy as sort of the lightning rod for the second tier of peripheral countries outside of Greece and Portugal and Ireland. However, I do think that there's more bad news coming in Spain, and that's really what S&P said. Be prepared for them to overshoot their fiscal deficit this year like they did for the last 2 years. Look for the unemployment to continue to rise, and look for politics. That's what they really focused on, is politics going to weaken their resolve for austerity.
Yeah, but Megan, how do you explain, you know, yields actually calming a bit and the equities market in Spain up on the news of the downgrade?
Well, I think that, you know, the S&P, all the rating agencies have really been a lagging indicator throughout this Eurozone crisis. And so, you know, they didn't tell us anything we didn't already know. If you read their report, it was all obvious to investors and to the markets. And so that's why the markets have hardly reacted to the news of the downgrade at all. I do think that things are set to get quite a lot worse in Spain going forward, though.
Okay, Mark, she's disagreeing with you here. And I'm hearing from Michael Crofton over here some acknowledgement that you agree with what Megan's saying.
Yeah, I think Spain is completely insolvent, and I think the rating agencies are irrelevant. I mean, they've proved themselves to be irrelevant in the last
time and time again.
Time and time again. So perhaps that's what we're seeing with these markets.
Well, I'll tell you what, Megan, jump it.
Megan. No, I think Mark
you got something, Mark?
He's saying no.
Yeah, I'm saying that, listen, if Spain gets downgraded to below investment grade, this is a big deal. This means that funds, you might think that the rating agencies are irrelevant, but for a money manager who's limited to investment grade securities, if a rating agency cuts them below investment grade, there's serious consequences. So I don't think that the rating agencies are irrelevant. I think they are slow, but this is a time where S&P now is lower than the other 2 rating agencies. So if S&P is behind the curve, what do we say about Moody's and Fitch? So I think that at least one of the rating agencies seem to be a little bit ahead of the others.
Yeah, but Mark, you know, think about it, Mark. You know, the Spanish market rallied 1.6%. The bonds on the Spanish 10-year are 5.82. The market shrugged it off. No, the market's telling you it doesn't matter.
I'm suggesting to you that because there was a bit of a buy the rumor, sell the fact. That is, Spanish stock market is the worst performing among the major industrial equity markets. It's the worst performing in Europe this year. The bond market's the worst performing. And so you take a one-day bounce and you want to make this a causal relationship with the rating agencies. And I think it's far from that. I think they're going to see Spain come under more pressure going forward. I think this is where we all agree on. I think that's what Megan said as well.
Look, I think that the ratings agencies really are only relevant insofar as some of the indices are automatically linked to them, but much more important is the fact that the ECB is going to accept Spanish collateral, whether it's investment grade or not.
The problem is the Spanish banks seem to be running out of collateral, and that's why I think one of the points there is the linkages between the public sector and the private sector. The Spanish banks have been hard hit this year, and I think we're going to see continued pressure on them. Sovereign gets downgraded. I would not be surprised to see the rating agencies also take another look at the Spanish banks. Santander reported this week, and they missed their earnings.
Okay, but let's go back to Michael for a second, because I think, you know, we started this saying, can this be a contrarian indicator? I'm hearing at least from 2 people on the panel that it is somewhat of a baked-in scenario. By the time the rating agencies get around to downgrading you, guess what, folks? It's time to call it a day.
And look,
things might actually be getting better.
Any bond manager who does not think that Spain is below investment grade at this point in time, regardless of what the rating agency said, isn't thinking clearly. Spain is going, Portugal's going, Italy's going. They're all going to go, but it's going to be Germany and the United States that decides when. They're keeping the whole thing afloat, and I'm really worried about it.
Well, Megan, I want to try to put a number on it. You're an economist, so you've run the numbers. You know the numbers better than anyone. Mark just made an interesting point. He said that is, it's going to be difficult for Spain to get more money. Spain has taken 47% of the most recent EFSF payout. So what happens next? Where is the money coming from, and are they really solvent? Try to put some numbers on it for us.
Yeah, I mean, sure, the money is going to continue to come from the ECB. The ECB has basically been funding the deposit flight from Spanish banks. And so that will continue to be the case for quite some time. And that's why I don't think Spain will actually be forced into a bailout quite yet. I think it'll probably happen early next year. But I do think Spain is insolvent. And, you know, watching Spain now is exactly like watching Ireland around October 2010 before Ireland was forced into its bailout, in that the government can't win no matter what it does. Yields rise, and the Spanish government announces further austerity measures. The markets freak out because they worry about the impact of those austerity measures on growth. If the Spanish government doesn't announce austerity measures, the markets don't think that the Spanish government is serious about reining in its fiscal dynamics.
Kind of a lose-lose scenario.
The Spanish government's in a position where it just can't regain market confidence.
So what's
and on
the
top
end
of
game?
that, you have this black hole in the banking sector.
Megan, what's the end game?
Spain will need a bailout, and that will buy a couple years of time. If you look at this big firewall the EU and IMF just put together last weekend at the IMF spring meetings, it's big enough to take Spain and Italy out of the markets for 2 years, but then when they have to return to the markets, they won't be able to, and they'll have to restructure their debt, and that will have huge implications for global growth.
Mark, your currency play here, do you go short the euro?
I don't think you want to go short the euro now. I think that one of those words that you were using before, resilience, the euro has been very resilient this week. I'm looking to, the euro has basically been trading a 130, 135 trading range. We're in the middle of that range. I think that investors are better served waiting for us to approach the top end of the range, but to sell the euro, to go short the euro, to reduce exposure to the euro at the top end of the range rather than here in the middle of it.